morning. Welcome to the South Dakota Business Law CLE. Should I start over, Bill?
No, you got it.
Okay. Yeah,
Rolling.
we're all here. We'll just get started. I'm Tom Clayton. I'm from Sioux Falls. I'm chair of this CLE today. And thanks to Deanne and Nicole and Bill for putting this together. Our first speaker will be Terry Pendergrast. Terry was an Augie grad and also a graduate of the University of South Dakota School of Law. He's currently a partner in the Murphy, Goldhammer, Pendergrast law firm and is a past chairman of this CLE committee. Terry's topic is going to be what is the captive insurance, this captive insurance, and why are some people excited about it. Terry was instrumental in putting the new law of captive insurance together. He was appointed by the governor to a task force to put these laws together to help Sioux Falls, South Dakota present itself on a national level. It's been a 3-year process, and Terry will be taking us through the process, hopefully some of the history, and then the nuts and bolts of the law itself. Terry?
Thank you. I wondered what the over and under would be for attendance at 8 a.m. to talk about captive insurance. How many of you have ever formed a captive insurance company? How many of you know what captive insurance is? Okay, great. Well, what I did in this presentation is I know that Shakespeare said that brevity is the soul of wit, but I felt that in order to really get into captive insurance, almost a captive insurance 101, I felt that most of you would be like I was 3 years ago when I started down this road of captive insurance. And so what I've done is I've got a presentation that I put together. I said, if you came to my office or if a client came to my office and said, what is this captive insurance? Why are a lot of people excited about it? What questions would you ask, and how could I answer them? And so that's how I approached the presentation, and then I went back and I filled in legal citations that you'll see. I filled in a lot of URLs from the internet, and I apologize initially for link rot. Do you know what link rot is? Link rot is when you cite to something that no longer works. Now, as of October 1st, every URL in my presentation works, but the U.S. Supreme Court since 1996 has had over 500 links to online material in its opinions. And a Harvard study last month came out and said that over half of those are broken right now, which means that if you cite and you click on the link that's cited in the U.S. Supreme Court opinion, you can't find it. So I apologize for link drop, but at least if you have an interest in this and you go to any of the URLs, you'll find that they work, or at least they worked as of October 1st. So we start out, what is captive insurance? What is a captive insurance company? And basically what a captive insurance company is an insurance company that writes coverage for the owners of the company who founded it. Insurance, if you go back to your law school days, Insurance 101 is just a risk transfer. We take a risk that one party has and another party says, I'm going to assume that risk for certain payments. So it's a transfer of risk, but in most cases, when you buy your auto insurance, you transfer that risk to a third party payer. In a captive insurance company, that third party payer is owned by you. And you say, well, why would somebody want to do that? Well, the most basic benefit to captive insurance is capital. When I pay my auto insurance premium, I never see that premium again. The business pays, it never gets that capital return to it. The only return is in the event you have a qualified claim within the policy period that the insurance company decides to pay off. But if you manage a captive well and the enterprise risks and claims are managed, you can return both claims payments and dividends in a more cost-effective manner. So there are certain things in South Dakota that a captive cannot directly insure. It can't directly insure life insurance, health risks, or personal lines coverage. The insurance company has to be set up through the State Division of Insurance. It has to meet the definition of insurance company that we'll talk about. But in most cases, what we found is that the way to do this is to not totally replace all commercial insurance, but replace the commercial insurance for more specialized risks or risks that you find will benefit the enterprise better. On page 2, I talk about who has a captive. Most closely held businesses with enough revenue have a captive, but all the Fortune 200 companies have captives. It may surprise you to know that a number of tax-exempt entities have captives, and you say, well, why would they do that? I thought that the reason to do it is tax advantages. Well, there are tax advantages, but there's so many other advantages in a captive insurance company that University of Michigan, University of Minnesota, number of companies have them. And then what's happening is many smaller companies are getting into captive insurance. I'm not going to go through any of the appendices, but at Appendix 2 you find an article from the New York Times of some small companies that have formed captive insurance. Well, the first question that clients would have is what rules of thumb? Who has enough capital to benefit from forming a captive insurance company? And depending on who's trying to sell you the captive insurance company, some use a revenue test, revenues of 25 million to 50 million at a minimum. Some will tell you as low as 3 million or 1 million revenues can form a viable captive insurance company. Some consultants use an income test and they say 1.5 to 5 million net income. Some say insurance premiums don't matter, and some say, well, if you have 500,000 to $1 million insurance premium, you definitely should be looking at a captive. So the answer to that question is really it depends. It depends on your clients, it depends on their business, their risks, including one-time risks, which I'll explain later. It depends on your client's wealth planning, business planning, and estate planning goals, and the considerations set forth in this presentation. But I really believe that many of our clients can benefit from at least consideration of a captive insurance company as part of their planning and business planning. And I know that this is scary for most people, just as dynasty trusts when they came out, or limited liability companies when they were new concepts. Many shied away because they didn't know about them. And after they found out, I think you'll agree with me that it's been a great boon to South Dakota, its small business climate, and the legal profession. It's quite likely that these same advantages will occur as we become more comfortable with captive insurance. There was a news article earlier this week from Vermont. Vermont kind of led the captive insurance charge, and Vermont chartered its 1,000th captive insurance company this last week. If you stop and think about what uninsured risks you have or your client has in its business, consider two companies. Both have $1 million in revenue. One has a chain of convenience stores and buys commercial insurance. The other's a doctor. He's got $1 million revenues. Well, the convenience stores are probably getting enough coverage from their standard commercial policies that it may not be beneficial for them to look at captive insurance. But the doctor is in an inherently risky line of business. And he's probably got sufficient risk to underwrite. He also has additional privacy, cyber liability, HIPAA liabilities, which are probably excluded from his current policy, or if they are included in his current policy, they're so limited that they might just as well be excluded. The only limit, if a captive wants to insure that risk internally, is that the risk has to be predictable, and if it's unpredictable, the captive will go out and get reinsurance on that. In addition, there are certain lines of business that, because of their inherently risky nature, are more likely to benefit from captive insurance. Obviously, we talked about medical professionals, but other service professionals, engineers, accountants, and lawyers are great candidates. Assume at your law office you have an identity theft situation, or a hacker attacks your computer server. The liability could be tremendous. Then go back and look at your current business liability policy and tell me whether that risk is covered. I think what you'll find is that it's not. Construction companies are risk magnets. Owners, developers of commercial real estate, anyone in the oil and gas business. If a line of business is not available in the commercial marketplace, the captive might be the only choice. And the good thing is that the reinsurance marketplace always is willing to take risks that the primary market does not want. But you or I as individuals, our clients as individuals, cannot access the reinsurance market. A captive insurance company can access that reinsurance market and get coverage. One way to consider risk is to look at the risk universe. And starting at page 4 of my presentation, I've got a couple charts. First, consider all the risks of a business, and that's the top chart. The second chart is the risks that the business probably currently covers. Probably has general liability, probably has workers' comp, probably has fire and accident coverage. You may have no coverage, you may have inadequate coverage, you may have excluded coverage. If you have an insurance policy, there may be big gaps in your policy. Most small manufacturers find that product liability or product recall insurance is one of the items that they cut out early because it costs so much. Estimates are that most businesses only insure 35% of their risk universe because they feel the other risks either are low probability or risks they're willing to take, or risks for which they cannot purchase commercial coverage. So if you go to the top of page 5, we've listed all the possible risks, and I'm sure that when you sit down with your clients, you can figure a lot more of these risks. But there's environmental risks, there's intellectual property risks, there's deductibles, because that's a risk that you're self-insuring. If I have a $1,000 deductible, I'm saying I'm going to self-insure that first $1,000. There's exclusions, which most lawyers know about in policies. Employer practices liability, overtime, regulatory actions. There's all these risks in the business. And some businesses say, well, we're going to add coverage. Their insurance salesman comes to them and says, well, we'll add employer practices liability, so if you get sued for discrimination or something, you'll have coverage. But if you look at those policies, we at our law firm actually bought some, and then I looked at the policy, of course, after we paid the premium. We got $300,000 additional coverage for that. The $300,000 included all defense costs within it. And so what you end up doing is you may not have $300,000 of coverage, and if there ever was a claim brought against you, the coverage might be inadequate. So even though your clients may think they're covered, you really need to look at the policies to see whether they are. In short, most policies don't have adequate coverage for certain risks that, if they would occur, they could seriously jeopardize the company's financial well-being. So at the bottom of page 5, what they've done with the risk universe chart is they've said, well, possibly could these risks be handled in a captive insurance program? And at the top, page 6, what we talk about is a captive insurance company can help to fill in the gaps in coverage. You create an insurance tapestry with your captive insurance coverage and your commercial coverage to cover the specialty risks. In this example, the chart at the top of that page, the previous premium was $200,000 for the company, but it had a deductible of the first $1 million it was covering. Formed a captive insurer, now it's got a deductible of 0, although it's paying $300,000. The $250,000 that it's paying for the initial insurance all goes into a pocket of its subsidiary. So any profits from that, any investment profits, and any underwriting profits go to the company itself. The company ends up a lot further ahead. A second way to consider risk when you're meeting with your clients is to look at your current policies and decide what's not insured or what's indeductible. One thing to remember is that we are all self-insured. You may think you've insured yourself against everything, but you are self-insured. Look at your current business policy and determine what risks you retain and what risks you've laid off to the commercial insurer. You retain everything over the limit of insurance. You retain the deductible, as I talked about, and you retain anything that the policy doesn't specifically cover. You also retain the risk in certain situations where your insurer, by the contract, has powers to step in to your shoes. For example, if you didn't have the insurance contract, you wouldn't have subrogation. That would be your right. If you didn't have the insurance contract, you could choose your own defense counsel. Now, when you've signed the insurance contract, they choose the defense counsel. You have the right to add other insureds. In addition, you retain 100% of the risks where you don't perform all of the conditions that lead to coverage. For example, if late notice of a claim goes to the insurer, you don't have coverage. And so therefore, when we talk about the universe of risks that you can control, I ask at the bottom of page 6, can you write the captive insurance policy to expand the limits, to cover the deductible, to cover the exclusion, to insure the risks that you clearly want insured, to grant rights to the insured, such as choice of defense counsel, and to adjust the conditions of coverage? And the answer in all cases is yes. This is one of the things that a captive insurance company can do. It's a risk-shifting device that helps smooth out the risk for our clients. And as my friend Mark LaPointe says, the time to establish a captive is when you do not need it. The concept is that when coverage is affordable and available, create a captive, start building up capital. If the market turns, you have the ability to leverage the capital, help smooth out the costs of your coverage. But don't think of risk just as traditional casualty risk. This was what I thought of 3 years ago when I started studying this. Risks of a business can include anything, and you can write a policy that covers these risks. It can include, as I've got on page 7, a whole list of things: administrative or legislative action or inaction, loss of a key contract, loss of a key customer, loss of a key employee, loss of a key supplier. It can include collections risk. It can include loss of a franchise license. It can include loss of a lease, business interruption exclusions from a policy, such as a blizzard or a short-term electrical outage of less than 24 hours. Last year in Sioux Falls, we had an electrical outage that closed down our law firm. When you lose your electricity, as many of you know, you also lose access to your server and your Wi-Fi and all these things, so it doesn't allow you to work from home either. And I looked at our business interruption policy. It was 5:30 a.m. on a Friday morning when we lost electricity to our building. business interruption policy said, yes, we'll pay you for the loss of that day of work, but only if the electrical outage lasts for 24 consecutive hours or more. So I was up at 4:30 Saturday morning praying that the electrical outage would last for one more hour. See, the exclusions in policies, you can write a captive insurance policy to cover those exclusions. And certainly the commercial insurers have reasons to put those in, but had that electricity come back on at 4:30 on Saturday morning, we would have had no coverage, and we would have been paying our premium for nothing. Fortunately, in our case, it didn't. It lasted to 6:30, and so we had 25 consecutive hours at work. But things like cyber liability, regulatory audit risk, violations of privacy laws, all of these are risks for which you can write a captive insurance company. And if you look at it, that the business already self-insures these risks. It just doesn't have the benefits of a captive insurance company that will pay the claims if one occurs. The business already assumes these risks for which it does not have commercial coverage. And if it suffers one of these losses, it must use its business equity to cover it. Wouldn't it be nice to plan ahead with your clients, to get these advantages, to build up equity if the business risk does not occur, and to have something there to cover it if that risk did occur? Risks retained in the captive obviously are still ultimately going to affect the financials of the owner. But what captives are is a long-term business strategy, and if the financial strength of the captive is weak in the early years, as I said, you can access the reinsurance markets. So at the top of page 8, this is from the Society of Financial Service Professionals. They just listed a number of potential policies. They came down to 1.2 million of annual premium for this particular business. I'll talk about that later, why that's an important number. But things that you could insure that I never thought that you could insure. Accounts receivable, administrative action, business interruption exclusions, which we talked about, construction defects, deductible reimbursement, environmental liability, errors and omissions, executive replacement. What if our executive leaves? Legal expense reimbursement, machinery breakdown. What if we don't meet certain production benchmarks? All of these are risks of your business for which you can write insurance. Now, I'm going to discuss the tax advantages extensively here, and I bring them up now because that's the one thing that people think about, and a lot of promoters promote the tax advantages of captive insurance, but I'm going to wait because the tax benefits cannot and should not be the chief motivator of the business decision. It's got to be a business decision. Many promoters only emphasize the tax advantages. In the past 3 years, when I've been asked, what is this captive insurance that you're getting excited about? A lot of times I go right to the tax advantages because it's an easy 90-second soundbite rather than a 90-minute presentation. But if the tax advantages are the reasons you're going to go into it, you're going to get in trouble with the IRS. The motivation cannot be tax avoidance, just like when we do family limited partnerships, just like when we do a lot of other trust techniques that benefit our clients. The IRS has said that if tax avoidance is the primary motivation, they can attack the deductions. And so what I'm telling you is don't send out emails to your clients, boy, I just heard this presentation on captive insurance and we can save you a ton of taxes, come on in. I would reword that and say something like, I heard this presentation and I think that we want to talk about a lot of benefits that can happen to your business, one of which might be, we might save you some taxes. If the only or chief reason your client can articulate to form captive insurance companies to avoid taxes, then that's probably not a legitimate reason to form it, and an IRS auditor will tell you that.
Terry, is that why 10, 15 years ago, it seemed like most captive insurance companies were being formed over in Bermuda and coming back to like a North Carolina? The reason I asked, I didn't form any, but I sure was in some litigation where they were trying to do in the particular industry in the United States, which when I read it made a lot of sense, but it was all going to have to go through Bermuda and all that, because I assumed the IRS was looking at this very carefully, and there weren't very many states in the United States that had any statutes on it.
Yeah, we're going to talk about that later, but there weren't many states. Vermont was one of the first. There's a couple reasons that people went to Bermuda. My senior partner, since deceased, Jeremiah Murphy, was with a group of Greyhound track owners, and they formed their captive in Bermuda. I don't think it was just for the tax advantage.